Hi, everybody. It's me, your agent Lene. Happy Thursday. I hope everybody's having a great day today. I had a great day today. I was out showing houses. I got a house under contract. Woo, woo. So it's still busy in real estate land. I wanted to talk to everybody who is new here and let them know that I am an agent with Keller Williams Realty. I have been an agent for 4 years. I'm one of the many talents on the Thrive team. And basically, I help people buy, sell, and invest in real estate. So if you're interested in learning how to get into real estate, if you just have questions, if you're ready to go, reach out, give me a call. Reach out, give me a call, email me. I'm here to help at any time. With real estate, today we're actually going to talk about loan programs and how you get approved for loans. Today is day 8 of the 25 days of real estate. So this is a good topic to cover now that we know what down payment is, the steps of real estate, and what's next. Financing is always a good part of your real estate transaction. So today I have Josh Cornett here. He is a mortgage broker with Green Trek Mortgage to talk to you more about loans and the different programs. Hi, Josh.
Hey, Lene, thanks for the invite. Appreciate it. And I don't remember what day it was. The day we're on now is day 8, right, Lene?
It's day 8. Mm-hmm.
Okay, yeah. So just thinking back to the last time I was on day 4 or 5, whenever that was, when we talked about down payment assistance. So I think that's been posted on both of our Facebooks. So definitely a good one to check out as well. And it kind of piggybacks on what we're looking at now. So if you want to start the slides, Lene, I will hop right in. Yeah, so mortgage programs, Green Check Mortgage. If you're going to get a mortgage, go to Green Check. How about that on that slide? But you can go to the first actual slide. So perfect. And as Lene said, I probably should have touched on this. I'm a mortgage broker, so there's mortgage lenders that are direct lending, where some of the big lenders you've heard of, like Rocket Mortgage, Quicken Loans, same thing, or Loan Depot, AmeriSave. Those are mortgage lenders. You've got banks like your local bank, whether it's Chase or Bank of America or Transcend here locally, or the list goes on. And then you've got mortgage brokers, which is myself. Obviously, I'm a broker, so I do think this side of the industry is best for the client. Believe it or not, you save a ton of money when you work with a broker. There's a lot of benefits, broker over banks. Some of the stuff we'll touch on, though, actually is really you can get anywhere. But most of the time, if you go with a broker, you're probably going to pay less, probably going to have a little bit better service. You're going to have my cell phone number. You call me, text me anytime, and I'm going to respond to you. So I would say working with brokers is a little bit better than some of the other parts of the industry. With that said, there are 4 main programs we'll touch on. There are tons more loan programs than that. Probably 95% of the loans that are done. That's not a statistic I've gotten from anywhere, just kind of going off my gut and conversation and 15 years of doing this. But I'd say about 95% of loans that are done across the United States are one of these 4 programs that we'll touch on. And so the first main program I'd say that's done, conventional loans. And they're on the slide. You can see typically conventional loan will be someone's got a 700 credit score or higher. It's your standard 30-year fixed, 20% down a loan is going to be a conventional loan. There are programs inside of conventional, though, that are first-time home buyer geared programs, like the Home Ready and the Home Possible program, which are 3% down programs that you can use down payment assistance with if you wanted to. Those programs are income limit, meaning if you make a certain amount of money, over a certain amount of money, you don't qualify for those programs. So they are they're a driven first-time home buyer driven program, but it's not a requirement. You don't have to be first-time home buyer. Again, that's just a conventional piece. Typically on a conventional loan, a standard conventional, you're going to be doing a 5% down. you don't have to have a 700 credit score. I mean, it's kind of ideal if you don't have 700 credit score. Sometimes the rate starts to get a lot higher on you. It's a loan that everybody's probably heard of, Fannie Mae and Freddie Mac. Fannie Mae, Freddie Mac really secure all of the conventional loan. Most of the conventional loans across the country are secured by Fannie Mae, Freddie Mac, meaning they're insured by Fannie Mae, Freddie Mac. When the loan closes, the guidelines are written by Fannie Mae and Freddie Mac. Those guidelines are really standard across the board with every bank, lender, and broker. There is flexibility inside of those. Sometimes you go to a bank, their guidelines for Fannie Mae, Freddie Mac are going to be a lot stricter than somebody like me that is simply doing a loan however Fannie Mae, Freddie Mac says they can do a loan. You go to your local bank, they may say, well, we can't do a conventional loan under a certain credit score. You've got to make a certain amount of money. And those are just extra insurances that bank might put in place. But again, Fannie Mae, Freddie Mac really control most of conventional loan products. And it's really more of your seasoned home buyer, seasoned homeowner that is going to do a conventional loan. Somebody that's had a mortgage before, had a house before. And these payments, once you have the loan, typically are going to be made to the loan servicer, which could be a loan servicer like a Rocket Mortgage is a loan servicer, or Loan Depot, or U.S. Bank, or Wells Fargo, and that list goes on and on and on. But just because it's secured by Fannie Mae, Freddie Mac doesn't mean you're going to make the payment to them. You're going to make the payment to any loan servicer like you would any other mortgage. So that's just a brief overview of conventional. There's a lot of stuff the criteria that fall under these. And so I'm just really touching at a super high level on some of these things. And really it's, I tell all the agents I talk to, and then even in more so to homeowners, is have an idea of what the process might look like. But you don't need to be an expert. You come to somebody like myself that is an expert to get the details on what route you need to go to get a loan. If you come to me, I'm not going to say, what loan program do you want to do? I'm going to ask you questions about your situation, find out what your goals and needs are, and then we're going to pick the route for you, what best program there is. Lene, you can go to that next slide, the FHA slide. So FHA, Federal Housing Administration. So this is probably the most popular first-time homebuyer loan, I would say. It is at the top of the list. And so you don't have to have the 700 credit score to get an ideal interest rate on an FHA loan. As you can see, most lenders will go down to a 580 credit score. But there are some lenders out there that I deal with that actually you can go even lower than that. You can go pretty far down into the 500s. A credit score is not the end all be all to getting a loan approval, though. You might have a 580 credit score, but there might be other, things in your situation. Maybe your income's not quite enough, or maybe you don't have the down payment, or you don't qualify for a down payment assistance. There's other criteria that the credit score is not the end all be all. But again, when you come to somebody like myself trying to understand if you're going to be qualified to buy a house, that's where I can point you in the right direction on if you need to improve your credit, and I can give you, pretty good insight on that. I've got some tools that I can use on credit to improve credit scores. But again, completely opposite of conventional, where you can go down a lot further on the credit score and be qualified for a mortgage. Like many of the first-time homebuyer programs, I touched on 3% down in that previous slide. FHA requires a minimum of a 3.5% down payment, but FHA does partner with a lot of down payment assistance programs. So if you don't have that 3.5% down, there's one program that I actually was talking to one of my lenders about today, that they cover all of that 3.5% down payment, either through a repayable, where you have to pay back this kind of secondary down payment loan, or actually a forgivable 3.5% down payment. So there are a lot of ways to get into a house without having perfect credit and without having the down payment. There really are programs out there that can get you into a house if you want to own one. It's just a matter of talking to someone like myself to, one, find out if you can qualify now, or two, if you're very serious about it and you're willing to, let's say, get on a 2, 3, 6 month plan. There's most of the time, anybody that's really, really focused can own a home or be qualified to own a home within 6 months, almost regardless of your situation, if you're disciplined about getting yourself in the right spot. So let's see here, looking at the slide. So FHA, one benefit, mortgage rates tend to be a little bit lower. Today, if you're looking at a 6.5 conventional interest rate, and right now it's December 8th, 2022. So if you're watching this in June of 2023, hopefully we're looking at 4% interest rates. But so let's say today you're at a 6.5 interest rate on a conventional loan, you might be at a 5.5 on an FHA loan. And you might say, well, why would I ever do conventional? Well, there's some give and take there. The mortgage insurance, the monthly PMI, when you don't put a 20% down payment, it's a lot higher on FHA. And it never goes away. If you have an FHA loan, if you're familiar with mortgage insurance, it doesn't ever go away on FHA. So kind of rough that way, but you could always refinance it and get out of it. Where refinancing would be where you are in a mortgage, maybe your situation changes and you want to get into a conventional loan. Maybe your house is worth more money and you can refinance. It's where you basically refinance is restructuring your home loan, hopefully to a better loan term. And so again, the monthly PMIs is more on an FHA, and FHA, as I'm noted there, they have a 1.75% fee that they put on top of the loan. And so that's just an extra cost that has to be accounted for with FHA. And when I say on top of the loan, what I mean is if you have a $100,000 loan and then FHA would charge you a fee of $1,750 that they would finance on top of that loan. And so it's an FHA fee. It's the way that the Federal Housing Administration, collects money through that one-time upfront fee and then through the monthly fee as well. Because FHA, they're not going to be the servicer of the loan. FHA secures the loan, but it's a government program that allows this loan to happen. But in this FHA product you'll make your payments to any other bank or loan servicer out there, just like you would a conventional loan. So, but Federal Housing Administration, FHA, like many other government products, they're government things. There is money being collected in different ways. And again, that's through the mortgage insurance as well as the FHA upfront fee that's charged. But again, FHA, probably top of the list on first-time homebuyer programs and even second, third-time homebuyer programs. If maybe your credit score is a little bit low, or maybe you don't want to put a larger down payment down, FHA is a fantastic loan. Okay, Lene, you can move on to the next one. All right, USDA, so United States Department of Agriculture. So this is certainly, if you're watching this and you live in Louisville or Jefferson County, or maybe even in Lexington, more of an urban area, more of this kind of city area, you're not going to see USDA. So USDA actually has a website. If you were to Google search USDA eligibility, then you'll pull up, it'll go to their website and there will be a map. You can literally type in a zip code or type in an address. And it's mainly for kind of the outskirts of an area. So, again, we're in Louisville, Kentucky. If you're looking in parts of Oldham County or parts of Bullitt County or, parts of Spencer County, Shelby County, those are going to be very popular areas for USDA. And if you're moving to an area where USDA is available, it is a fantastic loan program. Believe it or not, even though it says United States Department of Agriculture, and you would think, well, that sounds like a farm loan, and it isn't to some degree. There are plenty of USDA loans out, kind of the outer areas of cities and counties that it is a normal neighborhood. Regular neighborhoods have USDA loans. And so some really, really strong benefits. there on the slide. No down payment required, like none. So they USDA will allow 100% financing. So whenever you do see no down payment required, that doesn't always mean no money out of pocket. Whenever you're doing a real estate transaction, there's still a title company that has to be involved. And the team, my team, the real estate team I work with, and I'm not sure if Lene or not, but I know her team lead, Jamie Cox, Limestone Title here in Louisville, super popular, awesome title company here locally. You got to pay the title company. There's going to be some small, $300 to $400 transfer tax fees that you're going to pay. You have to prepay property taxes and homeowners insurance when you buy a house. So even when you see no down payment required, what that means is you'll get 100% financing for the purchase of the home, but there's still transaction fees that'll have to be accounted for. In this market that some would argue is seller buyer's market, I would say the way things are acting, it's a buyer's market. You can probably get the seller to contribute and pay for all of those transactional costs that you have. And you can get into a house with no down payment if it's a USDA type program. So if you're willing to move, again, if we're talking in Louisville, Kentucky, if you're willing to move to parts of Mount Washington or Shepherdsville or Simpsonville, Shelby County areas, you're okay being out a little bit further. When you were to reach out to me, we can check on a particular address, and you very well may qualify for a USDA loan. And if you do, depending on your situation, I'm probably going to tell you, hey, this is by far the best route to go. And some of the reason is I touched on that mortgage insurance, that PMI with FHA that's kind of expensive on a monthly basis. It's a lot cheaper on USDA, a lot cheaper. The rates on USDA fall somewhat in line with where the rates are going to be on an FHA loan. So again, if you're on a little bit lower credit score side, and we talked about conventional rates being a lot higher, if you have a little bit lower credit score, USDA is not like that. The rates aren't going to go crazy on you if you get down in the 640, 630, 620 credit range. Obviously, you're probably not going to get the same rate as if you had a 700 plus credit score, but USDA is very similar to FHA in that way. One other little note to just take note of on USDA, there are income caps, income limits. So they're quite a bit higher than the income caps on some of the first-time homebuyer programs that we touch on. But there are certainly income caps, though, on USDA where if you make over X number of dollars, then you're not eligible for the USDA program. So not to jump around, but FHA does not have that. FHA is you make whatever you want, and you're going to get you're going to be able to qualify for an FHA loan. USDA does have the income caps on it. So again, with all these loan programs, there are if you go to a lender's page, or the guidelines for this stuff is literally hundreds of pages. So it's impossible to really get into all the details of it. Again, I'm just trying to really hit some high level things. So maybe this sparks the interest, like, hey, I actually thinking about moving to Shepherdsville, but I thought I needed a bigger down payment. Maybe USDA would work. And again, that's where you contact Lene and say, hey, Lene, I want to go look at a house. And she would say, hey, talk to my mortgage guy, Josh at Green Check, and let's make sure you're qualified. And so it's all about having an idea of what's available and then knowing who to talk to put you point in the right direction. Okay, Lene, we can go to I think the last one, VA loan. So VA loan, Veteran Affairs, what you may suspect, this is a program for those that served in the military. So not everyone can go get a VA loan. It is a fantastic loan program, and I would venture to say better than the other three I've even touched on in most cases, for a couple of reasons. But a VA loan is for those that served in the military, and can't be, you can't be the son or daughter of a veteran. It's, got to be the actual person that served, if you're active duty, if you're an active duty military, National Guard, depending on how long you've been in, you'll qualify. In some cases, depending on how a veteran may have passed away, the surviving spouses can be eligible for the VA loan. And again, what I've touched on some of the other programs, VA has no down payment, so zero. The VA will finance 100% of the purchase price. And what's unique about VA, a little bit different than FHA and certainly different than USDA, VA has none of that mortgage insurance, no PMI. And so if you're doing, let's say, a $200,000 loan on an FHA, then your PMI would be about $170 a month. If you're doing that same loan amount on a USDA, then your PMI would be 70 or 80 bucks. With VA, there is none. So very unique in that way. VA does, one negative to VA, there is quite a large, what's called funding fee. Kind of going back to what I said about the FHA, that 1.75% fee that FHA has, VA has that same type fee, similar size, depending on how many times you've used a VA loan. That fee can be over 3% of the purchase price. So again, VA will finance that, so it would get stacked on top of your loan and the financed amount. But there is that one exception to that, though. Any veteran that is 10% or more military disabled, actually the VA waives the funding fee, and obviously that individual, they pay the price if they've got any type of service-related disability, but the VA does waive the funding fee, and so that can be a savings of thousands and thousands of dollars for a disabled veteran. VA also has less income requirements, so an individual that might get pre-qualified for a $200,000 house on an FHA loan, it would not be uncommon that individual is qualified for a $250,000 house on a VA loan. So they don't have the monthly PMI, so that's a cost that you don't have to pay, and then also they just allow for higher what's called debt ratio, meaning your total debt payments, mortgage payment, in comparison to your monthly income. VA just allows for the income to be less or those debt payments to be more, simply put. So the VA, as I mentioned, between the 100% financing, the no PMI, the debt ratio allowance, that allowing you to go up higher on what you can spend, for those reasons, it's a fantastic loan product. And I may not have touched on this with FHA, but in most cases, same with VA, you're only allowed to carry one FHA, you're only allowed to carry one VA loan at a given time. Now, there are circumstances where you can get away with that if you're maybe moving for a military reason and moving across country. Then you can, in some cases, keep two VA loans at one time. For the most part, though, you're only able to have one VA loan. So if you're a veteran, you can't buy a house and another and another and another using this VA loan, doing 0% down every single time. It won't work. If you're trying to do that, you're only going to be allowed to have one VA loan at a given time. So anyway, it's a fantastic loan product. Really, all of these products, conventional, which is a lot of what I do, because there's so many categories that fall under conventional, FHA, USDA, and VA. They're the four big hitters in the mortgage world. There are so many other loan programs that are out there that I haven't made any slides for, whether it be an investor loan, like what's called a debt service credit relief loan. It's kind of an investor-driven loan. Bank statement loans, where maybe you're self-employed, don't claim a lot of income, but you got bank statements to show that you have the income. These are all completely separate loan products that don't fall under the category of any of these slides. But there's so many more loan products out there that it'd be impossible to cover all of them and impossible to cover all the guidelines. But, if you've got a situation that maybe you've had a home before and maybe you think your situation is different and can't get a home loan. I talk to so many people that almost assume there's nothing they can do, and come to find out they're in a position to buy a house, and they've been, staying where they are for a year, 2, 3 years because they just assumed certain things that weren't actually true. And I think that's it. Lene, you can go to the next slide. Yeah. So questions, if anybody on here, that QR code will take you to the Green Check website. My email, phone number. Lene will be posting this on her Facebook. I'll be reposting on my Facebook, and I'm hopefully have a few will repost it on their Facebook. So that's it. Lene, can I? Is there any questions I can answer for anyone?
So one of the questions is, can you buy a house with no money at all? Most of the loan programs say that they need down payments. Is there a way that you can get through the whole system without any money at all?
Not quite no money at all. So, we touched on the Louisville down payment assistance last week sometime. And so like that you're going to have to contribute $500. And then they're also going to want to have $1,500 you'll have to contribute $500 toward like appraisal or inspection or something like, anything kind of transactional related. And they require $1,500 in an account. Could some of these programs require inspections and of the home, that's almost always paid by the buyer. And then the appraisal is commonly paid by the buyer as well. So as you know, Lene, those are probably, would you agree, an inspection is probably $500-$600, right?
On average, they're about $500. Yeah.
Yeah. An appraisal is about the same. So can you do it without having the down payment money or a certain amount of reserves or assets, just in a checking savings account? Yes. Can you do it without putting any money out? Pretty tough to do that because, again, the two main big hitters that are going to come up are appraisal and inspection. And if you're coming into this, that's going to be about $1,000 that you'll need to get that done. Other than that, yes, you could get into a house without really anything else.
Okay. Another question we have here is, what is the minimum amount for a loan?
Yeah, that's a great question. So what you run into is, most of the time it's about $50,000 or $60,000 is going to be the minimal amount somebody like myself would be able to do. And really, the reason for that is there becomes a profitability problem if it gets much lower than that. Meaning, if a lender servicer is giving you even a $60,000 loan, sure, you could say, well, you're going to make interest on that for the next 30 years, which is true. But that's going to take a long time to make any money. And there is, between underwriters, processors, you have to factor in that these lenders, brokers, they're paying rent somewhere probably. They're paying for software. And there's a lot of stuff that goes in. There's paying for licenses and, compliance. And that doesn't fall on just one loan, but it falls into the operating cost of a lender. And so a lender has to do a loan that's big enough to where they can charge a rate, but then also have a certain amount of fees on a loan so that it is profitable and not losing money. And a lot of times, once you get around 50, 60,000, it becomes very difficult to get a loan done. And if you're below that, I will tell you, come to me, right? Because I'm a broker and I can get a lot of stuff done, which is very true. Lower loan amounts is where you really need to go to your local bank. If you're dealing with a $50,000, $40,000, $30,000 mortgage amount, then you probably go to your local bank where they're not as concerned about any transaction fees. They're going to take your loan. They might make you open a checking or savings account, keep a particular amount of money in there, and they're going to look to maybe create a relationship with you, and maybe get a car loan for you or things like that. So yeah, that's the loan amount can be tricky. That's kind of a one-off. But once you get around, I'd say 60,000, much less than that, you're not going to be able to get a whole lot. It's going to be tough to get anything done.
On the opposite side of this, is there a maximum amount for a loan? A lot of people.
Yeah, great question. So FHA does have a loan limit. I mean, where you can't exceed a certain number. And then Louisville, Kentucky, I'd have to look it up. It changed for 2023. I think it's somewhere around 420,000. The conventional loan limit's around 720,000. And then once you get past a conventional loan limit, then you move into the jumbo world. And so, the jumbo, the lenders I work with, I think 3 million is the cap. So, if we're talking about numbers like getting into the millions from a financing standpoint, obviously we're probably moving away from the first-time home buyer unless they won the lottery, yeah. So from an income cap, yeah, you're in the hundreds of thousands on where the income cap will be. And I see Sherry Walker is back. Let's see. She wrote, do you see the, I'll read the comment, Lene, what she said. Will they do a soft credit check or a hard credit check? Cause I know I have a, okay. Like pre-approve it. I don't want to add. Makes sense. Yeah. So can a soft credit check be done? Yes. Soft credit pulls are kind of tough though, because a soft credit pull reads a lot of times like a Credit Karma score or so many. I mean, it seems like in the past 5 years that the ability to access our credit scores is just blown up. Every credit card can give you a credit score. Credit Karma is a really, really good one. It's a free tool. Most of the time, a Credit Karma score or any other score like that you can get online or get with your credit card company, even if it's coming from Experian or TransUnion or Equifax, most of the time it's going to be very similar to a soft credit pull. So I'm not a big fan of soft credit pulls because they really don't give us a whole lot of information that you can't get on your own. And unfortunately, the mortgage credit score is going to be a little bit different than what a soft credit pull or Credit Karma score would be. And so I encourage people, if they don't track their credit, go to creditkarma.com right now and take 5 minutes and set up an account. It does not cost you anything. It's an incredible resource. Obviously, there's built-in ads and all kinds of stuff they'll try to sell you, and credit card offers they'll try to sell you. I would say if you're above, let's say 640 on your Credit Karma score, you're probably in a spot to get a loan. I'm not promising that, but you're probably in a credit spot to get a loan if you're above a 640 on Credit Karma. If you've got a 640 on Credit Karma, but you don't really have any derogatory in your history, and maybe it's just length of time that you've had credit, meaning you've got pretty good credit, but you just haven't had it for very long, then more than likely your mortgage credit score is probably way higher than what Credit Karma reads. And so that's it. Sherry, feel free to reach out to me directly on that. Give me a call or shoot me a message directly, because it gets a little bit tricky. But again, not a big fan of soft credit checks. I don't really think they do a whole heck of a lot on giving indications on what's really possible. And I think you can get the same information from a Credit Karma report. And you call somebody like me, we talk about what's on Credit Karma, and I can gain some insight on what the hard credit check might look like. Yeah.
That sounds
wonderful. What is the minute? Yeah, we already covered the minimal loan amount, so I think we're good there.
Okay. Are there any other questions? Well, Josh, thank you so much for being online with us.
Yes.
So today we're actually giving away a $25 gift card to Starbucks. I hope everybody signed up and filled out the forms today. All you have to do is go on. It's in the chat. It's on the screen right now. It is on the Facebook page. Make sure that you fill out that form and sign up to win today's gift.
Lene, you are killing it with the links and the screens and the pop-ups. You're doing awesome.
We got to keep them informed, right? This is how they learn how to buy a house. So we got to give them all the information.
Yep, that's right.
Well, Josh, I want to thank you so much today for coming on and talking to everybody again. Remember, everybody, get them, talk to them, get on. You can hit them by phone, email, GreenCheck, J. Cornett, at greencheckmortgage.com. Make sure you call them and Josh, let's get them in a house.
Yeah, for sure. Sherry asked what the other link was for. I'm assuming, looks like you've got a USDA link, eligibility link, and then you've got the Credit Karma link in there. I'm not sure which one, Lene. Oh, well, this link too. What is the link on the screen right there, Lene?
So the link on the screen is actually how you fill out the form to get entered into the giveaway.
Got it. Okay. Yeah. Sherry was asking. So cool. Awesome. Well, I appreciate it, Lene, and love the opportunity and love talking to you. And anything we can do together, anybody reaches out to you and got a mortgage question, let me know how I can help.
Always, always. Thank you so much, Josh.
Okay. Talk to you soon. Bye.
Talk to you soon. Bye.